Very good evening to all of you. On behalf of Auditing and Assurance Standard Board of Institute of Chartered Accountant of India, I welcome you all in today's 101st CP program organized by AASB of ICI for this council. As we all are aware that we are running one series on various webinars on key consideration in audit of listed companies. We have already covered the LODR requirements, CARO, Schedule 3, internal financial control, as well as the requirements for the NBFCs. Today, we are going to cover the very important part for the chartered accountants, that is the auditor's report, qualified as well as non-qualified. In order to tackle these two very important topics, very important part of the auditor's report, we are having two learned speakers with us, CA Pushkarji and CA Pankaj Handa. So on behalf of AASB of ICI, I welcome you, both the learned speakers on this AASB platform. Welcome Pankaj, welcome Pushkarji. We are having with us two moderators also from own our chartered account fraternity, CA Pankaj Jainji and CA Sumit Bansalji. Both will moderate with our today's webinar. So on behalf of WSB of ICI, I extend warm welcome to both the moderators, Sumitji and Pankajji. Welcome to Sumitji and Pankajji. I also welcome all the participants of today's webinar. So Honorable Chairman and Vice Chairman both are stuck up in another meeting. So taking this liberty to start the proceedings of today's webinar. So without wasting much more time, I request Sumit Bansalji to please start the proceedings of today's webinar. Over to you, Sumitji, please.
Thank you, sir. I welcome Chairman, sir, and Vice Chairman, sir, of ASSB. I, CA Sumit Bansal, along with my co-moderator, CA Pankaj Jainji, really thankful for Chairman, sir, and Vice Chairman, sir, for giving us this opportunity to moderate this program. I also welcome all the participants that who has attended today. I also welcome today's speaker, Mr. CA Pankaj Handa ji and CA Pushkar Salalkar ji, for taking out time from their busy schedule to impart us knowledge on today's topic of key considerations in audit of listed companies. Now I read the profile of CA Pankaj Handa ji. CA Pankaj is a director in audit and assurance practice at MSK and Associates based out of Gurgaon. He has over 16 years of auditing experience spanning across various industries and is a subject matter expert on Indian GAAP, Indian AS and IFRS. He has been part of several large listed and medium-sized IFRS India's conversion projects. He has demonstrated excellence in leading the complex and large group financial statements reporting having 50 plus subsidiaries. Prior to joining the firm, he was with the KPMG for 7 years at Deloitte for 8 years in the audit and assurance practice based out of Gurgaon. On the past engagement, his responsibility includes leading the audit team, dealing with the client during the field work process. He was involved in discussion with the promoters, senior management, audit committee, and board of directors. Pankaj throughout experience is in the domain of risk assurance, statutory audit. He is having various sector experience, including power, renewable, manufacturing, automobile, consumer market, hospitality, and many more achievements. Without wasting much more time, now I would request my co-moderator, CA Pankaj to take up the session from here on.
Sumitji, I take this opportunity to welcome and thanks to CA Dr. Sanjeev Kumar Singhal ji, Chairman sir, and CA Vishal Doshi ji, Vice Chairman sir of the AASB of the ICI for organizing this event for on much requirement topic of key consideration in audit of the listed company. I thanks to give this opportunity to being the moderator of this session. I welcome our today guest speaker, CA Pankaj ji and CA Pushkar ji for taking out their time for today's session. I will also welcome to all the participants. We have with us guest speaker, CA Pushkar ji. Pushkar ji is a chartered accountant and has also completed his master in commerce from Mumbai University. He is currently working as a director of the insurance practice of SRBC and Company LLB. He has 15-year experience in field of the auditing and financial reporting and advisory matters. He has led audit of the several large companies, including the companies engaged in the metal and mines, industrial product, media, and logistics sectors. Puskarji also has a significant experience of managing capital marketing transactions, including the bond offering on overseas stock markets. He has gained significant exposure by working in office and assignment in USA, Kuwait, and Switzerland. Now, I request to CA Pankaj Handaji to please give us inside the audit report, modified and unmodified. Thank you.
Thank you, Pankaj. Just give me a second, I'll just put in my presentation. So thank you everyone for giving me this opportunity to present, I think, a very important topic for all of us as a chartered accountants, because this is with regards to the audit opinion or the audit reports that we are about to issue on various listed and unlisted engagements. So the audit report is applicable for both private and listed and unlisted companies. However, we are focusing more from a listed company perspective. The webinar series is from that perspective. So overall, from a structure or curriculum perspective today, I'll try to cover these aspects. I'll quickly touch upon a couple of parts of the audit reports, just to give an understanding to the audience and the members who are present on the webinar right now. Apart from that, I will also try and touch base on the various kinds of modifications which we generally do in our audit opinion. So there are various kind of audit opinions that we issue, so we will try to cover those as well. So as we all are aware that as an auditor, we have a responsibility to issue, to form our audit opinion on the basis of the financial statement while performing our audit procedures, which is in line with the standards on auditing. So this is a basic broad structure of our audit report, which we generally issue. And these are the key components of our audit report, which we look into while issuing an audit opinion. Generally, while issuing an audit opinion, we need to firstly identify and come to a conclusion that what is our opinion that we are going to issue on these financial statement basis of the work that we have performed so far. Whether we are able to obtain corroborative and conclusive audit evidences, our audit opinion we have performed sufficient and appropriate audit procedures to issue the opinion. All these items or the factors will be considered while issuing the audit opinion. So these are critical components while deciding on the opinion to be issued. Apart from the audit opinion, in the audit report, these are other reporting matters, reportable matters that an auditor has to report upon, which are also equally significant. The modifications and the opinion, generally, which is classified into the emphasis of matter paragraph, or we issue a qualified opinion, we issue an adverse opinion, or we issue a disclaimer of an opinion. Apart from that, there are other reportings also, which are covered as part of our audit opinion, which is with regards to reporting under 143(3) of the Companies Act. So these are the reporting requirements under 143(3), wherein the auditor is also required to perform procedures to form an opinion and to comment accordingly on these components as well as part of the audit opinion to be issued. So the learned, the chartered accountant esteemed members, they need to have appropriate documentation in place to ensure and corroborate that the appropriate procedures have been performed to respond and to conclude on the reportings which are included in the audit opinion or the audit report. So the first matter under the 143(3), which is to be reported, is with regards to the auditor has to confirm that he has sought and obtained all the information and explanation which is necessary for the purpose of his audit, which is also significant while you are concluding. So this is again kind of a extension of the audit opinion that we are issuing, because if we have not obtained all the necessary information and explanation, then it has an impact on the overall audit opinion as well. So 143(3) reporting is also somewhere related to the main audit opinion which we issue in our audit reports as well. So the auditor, while responding to these questions, needs to be more cognizant and vigilant that whether they have obtained all the necessary information, explanation, the knowledge and belief with regards to the conclusion to be reached out to issue an opinion. Second, with regards to the maintenance of the books of accounts. So while the auditors are looking into the financial statements, the books of account, they need to also ensure that they need to also opine that the proper books of account as required by the law have been maintained and they have been adequately been maintained. So depending on if the company is having branches, then they need to look into the branch audit reports also from to that extent. So similar is the other reporting requirement on the branch office as well, which is to be covered as part of 143.3 reporting. Then these are the other items of 143.3 reporting, which is to be looked into by the auditors or while issuing the audit opinion, which are extremely significant and important because this is somewhere related to the main audit opinion as well. Like the opinion on the financial statement that they comply with the applicable accounting standards. So if the auditor is coming across a situation where they have identified any misstatement, which is on account of non-application or incorrect application of the accounting standard, then this will have an impact on the 143.3 reporting also, which the auditors will have to be cognizant on while deciding on the opinion. So there cannot be a situation that you will be having a disparity between the audit opinion issued and the reporting done under the 143.3. If in any situation the auditor concludes that they have an impact on the main audit opinion, while supposedly they are qualifying, on account of the accounting being done in the audit opinion, and they are not considering, to report under the 143 under 143.3E, then they need to have, they need to be very cautious about it because this will have an impact on the audit closure and the opinion to be issued, because there will be no parity between the main audit opinion and the 143.3 reporting as well. So these are very important aspects which needs to be looked at while we are issuing our opinion on the audit of the financial statements. Similar is in the line of the financial statement or the transaction, anything which has come across or anything which has been identified by the auditors as part of the audit procedures, which is having an adverse, which is expected to have an adverse effect on the functioning of the company. This can be looked into from various aspects, like the company is having going concern related issues, the company is having significant outstanding litigations. So all those things you might have analyzed while you were looking into the audit opinion. So when you are concluding on that in the 143 reporting also, the auditor or the member has to evaluate that whether it has an adverse effect on the functioning of the company. If it has, then appropriate disclosure with regards to the same, or the qualification to that extent in 143 reporting is also to be done. Moving on, then there is another aspect which is to be covered with regards to director disqualification. If any of the director who are on the board of the company is disqualified under section 164, basis the director's declarations that has been obtained, any ongoing legal proceedings that you have come across. From all those aspects, if any director is found to be disqualified, then an auditor is required to report under the 143.3 reporting, and also to evaluate that whether it has an impact in terms of the main audit opinion as well on the functioning or the true and fair view of the financial statement as well. Then for any qualification, reservation or adverse remark with regards to maintenance of accounts or other matters connected with regards to these maintenance of accounts. So if something has come across as part of the audit procedures which the auditors have performed, which is triggering to kind of a qualification or a adverse remark in the financial statement, then the auditor needs to consider those aspects to be reported under this 143.3 reporting as well. And this is a significant aspect which is to be evaluated while the auditors are concluding on the main audit opinion also, which we'll be covering in the subsequent slides as well. So apart from that, there is a reporting with regards to internal financial controls. So as we are aware that the listed companies in India are, as an auditor, we are required to opine on the operating effectiveness, design and operating effectiveness of the internal financial controls. There is a separate annexure with regards to that. So if any, if the auditor has come across any situation, any transaction, any material misstatement, any gap or being pervasive or non-pervasive, being material or immaterial, or whether it is just from the perspective of highlighting it to the readers of the financial statement to gather their attention, the auditor needs to evaluate if it has any impact or a bearing on the opinion to be issued under the internal controls over the financial reporting as well. And if that is having an impact, then it also is required to be covered as part of 143 reporting that this is there. These are the other matters which are also to be covered under 143.3H reporting, which is also procedural with regards to, if the company is having significant amount of, or if the company is having any pending litigation, the auditor is required to refer it back to the financial statement where the appropriate disclosures of the outstanding or pending litigation which are ongoing in the company have been dealt with and disclosed in the financial statement appropriately in line with the applicable accounting standards and the disclosures required under the Schedule 3. So the auditors needs to refer it back to and put it across, the references of the financial statement and include a proper disclosure which is in line with the accounting standard and the Schedule 3. Then there is a disclosure with regards to the material foreseeable losses which the company is expected to incur on account of any long-term contract, derivative contract, any onerous contracts. So all those also to be covered and evaluated by the auditors while doing the audit. So like onerous contract, if the company has entered into any kind of a contract which is expected to incur a loss at the end of the tenure, then the company is required to consider a provision for the loss which is to be incurred in the subsequent period. And those contracts become an onerous contract, and it requires a disclosure in the financial statement as well from that perspective, because that's a separate provision considered in the contingencies as per the accounting standard. So those are also required to be disclosed over here. Then there are disclosures required to with regards to investor education and protection fund. So these are certain kind of disclosures as required under the reporting of 143.3. So I would like to firstly pick it up that how do we form an opinion on the issuance of the financial statements. So an auditor, while forming an opinion on the issuance of the financial statement, the auditor is required to express. If the auditor concludes that he is going to express an unmodified opinion, that means the auditor is able to conclude that the financial statements are prepared in all material respects, basically in accordance with the applicable financial reporting framework. So if anything which has come across as part of the audit procedure which has resulted into identification of any misstatement or probable misstatement or a material misstatement which may impact your opinion in terms of a true and fair view of the financial statement, then the auditor should evaluate that whether they have been able to conclude on the financial statements been prepared in the all material respects which is in line with the applicable accounting framework. If the auditor concludes that based on the audit evidence obtained, any part of the financial statement or whole of the financial statement is not free from material misstatement, or if the auditor concludes that as part of the audit procedures performed, there is a sufficient appropriate audit evidence available to conclude that there is a material misstatement or there are chances of being material misstatement. So then the auditor is required to evaluate the modifications which are required to be done in the audit opinion appropriately, depending on the quantum, the nature, and the extent of the material misstatement which is expected on account of those aspects which has been highlighted as part of our audit procedures. So how we can conclude on what kind of modification is considered to be appropriate while issuing our audit opinion. So if we factor our material misstatement into various categories, so while the auditor is deciding that what all categories of opinion will how a kind of a material misstatement is going to impact the overall judgment of the the readers of the financial statement and how it is impacting the financial statement, then the auditor is required to conclude accordingly that how it is going to impact the audit opinion. So suppose these are certain kind of situations wherein the auditor will have to fit in the criteria while evaluating that what is the probable impact of those misstatements which have been identified as part of the audit procedures, and accordingly to be disclosed appropriately in the auditor's opinion. So supposedly for financial statement misstatement has been identified which is material to the financial statement, but it is not pervasive in nature. So over here, when the auditor is deciding on to issue a qualification adverse opinion or a disclaimer of opinion, one aspect which is very important to be evaluated over here is with regards to pervasiveness of the misstatements. So there can be a situation that anything which has come across, which the auditor has come across, which is kind of a non-compliance or a regulation error, or there is any kind of a misstatement which has been identified. But firstly, the auditor needs to conclude that whether that misstatement is material to the financial statement or not. Because if it is not material to the financial statement, then it will not impact the overall audit opinion to be issued by the auditors, while considering the materiality which has been computed in line with the standard of auditing. So once the auditor concludes that the misstatement which has been identified as part of the overall process is material, then the next step which the auditor will have to evaluate is whether that material misstatement is also pervasive in nature. When we say pervasive in nature, it means that it has an overall impact on the consideration of the audit report, to an extent that it is not only confined to the specific elements of the financial statements. It also represents substantial portion of the financial statements. So supposedly the company is a real estate company. You have identified a misstatement in the line item of the inventory or the land, which land parcel which the company is holding, which is again a form of inventory, maybe developed or undeveloped land parcels. So in those cases, if in a real estate company where there's only one project being underway, if you have identified a material misstatement in the inventory valuation, and that overall inventory value in the ticket size of the financial statement covers say 70% or an 80% of a kind of a asset size or asset value overall, then it becomes pervasive. And if it becomes a material and a pervasive kind of an error or a misstatement, then the auditor needs to issue an adverse opinion in such cases. If the auditor concludes, basis the procedure performed, that the misstatement which has been identified is material, but it is not pervasive in nature, that means that supposedly a company has committed a non-compliance, which will result into a penalty to the company, which will be kind of a material penalty, and that will have an impact on the overall P&L of the company. But after paying that penalty, and that overall ticket size of that penalty is not so significant to the financial statement that will have a pervasive effect on the functioning of the company or the operations of the company or the size of the company or the fundamental understanding of the uses of the financial statement, or if there is any disclosure which is specifically not being considered, which is required. So all those aspects will result into a pervasive kind of a nature. Otherwise, if those are not the criteria which are getting met over here, then the auditor will end up issuing a modified opinion in the form of a qualification. So in the other cases where the auditors have come across a material misstatement which are not pervasive, but on account of their inability to obtain sufficient and appropriate audit evidence. So if the auditor is not able to perform, or obtain a sufficient or appropriate audit evidence, which is specific to a specific financial statement line item or a financial, statement area, or maybe a specific regulation, then the auditor needs to evaluate that the overall impact of that material misstatement on account of this, shortfall of the information or the, availability of the exact, minute or granular details that are required to evaluate the overall extent of that information, will come across to be a material but not pervasive to the financial statement, because the line item to which this material misstatement or this scope absence is triggering is not overall pervasive to the size of the financial statement. Then in such a case, again, the auditor will end up issuing a qualified audit opinion instead of issuing a adverse opinion. But if the auditor is unable to obtain sufficient and appropriate audit evidence, and at the same time, this misstatement which is getting triggered on account of the unavailability of this sufficient appropriate audit evidence is material, as well as the financial statement line item with respect to which this misstatement has been identified is also pervasive, then the auditor will end up issuing a disclaimer of opinion because they are unable to conclude that the financial statements are free from material misstatements. So they'll not be in a position to issue a true and fair view on the financial statements. So hence the auditor should consider to issue a kind of a disclaimer of opinion in these cases. So every situation has to be evaluated. So one situation, supposedly, I'll take an example. Company is dealing with the foreign parties, wherein the company is having foreign exchange dues or maybe receivables from the foreign exchange foreign parties. Those fall under the guidelines of FEMA, and under the FEMA guidelines, if those are not collected within the stipulated limit or the time period, then it becomes a violation under the FEMA rules. With respect to that, the company is required to do the remediation steps. While concluding, the auditor comes to a conclusion that the overall quantum of transaction with these foreign parties, which is affecting the financial statement line item, state trade payable or state trade receivable, in depending on the receivable balance or payable balance, is material to the financial statement, but the overall outstanding balances of trade receivable is not so significant in the financial statement that the other captions of the balance sheet items are not giving rise to a pervasive kind of a impact. So there is no pervasiveness of those misstatements. In such cases, the auditor will consider to issue a kind of a qualified opinion. But if a similar situation is happening in a case where the company is having significant amount of receivable or payable balances outstanding, and that is covering say 50% or more, taking as an example, say 50% or more as the overall ticket size of the balance sheet item, then the financial statement caption to which it affects is material, as well as it is on the other side a pervasive error also. So the same matter can result into an adverse opinion also. So every matter, depending on the facts, circumstances, characteristics, and the overall impact of those quantum, needs to be evaluated to be concluded that whether it will result into a qualified opinion, adverse opinion, or in cases where there is kind of a inability to obtain appropriate evidences, the qualified opinion or disclaimer of opinion. So these are the broad categories which the auditors will have to be cognizant of while fitting in the auditor's opinion into a one bracket and issuing an audit opinion accordingly. So this is a kind of a stepwise approach which the auditors will have to take in case of scope limitation which has been identified. So if an auditor requests the management to remove, say, supposedly the scope restriction, if the management is not allowing you to reach out to the if the company if the auditor is auditing the holding company, and the management of the holding company is not allowing the auditors to reach out to the component auditors to obtain an understanding from them that on the procedures and the extent of procedures that they have performed, roll out the instructions to those component auditors, and those components become kind of a significant or a material component while you are signing the overall consolidated financial statements. Then in such cases, the auditor should firstly approach the management and push for that they should remove the scope limitation or restriction, as the auditor in such cases will not be in a position to obtain sufficient and appropriate audit evidence to conclude on the overall true and fair view of the consolidated financial statements. In such cases, if the management allows, then it is fine. The auditors can perform the extent of procedures which are required to be done, and they will be kind of moving towards evaluating and concluding that the appropriate audit evidences have been received. But in case if the management still persists that they will not be allowing you to perform those extended procedures or reaching out to the component auditors or just to make a noting of the auditor's report which has been issued on those subsidiaries, or these subsidiaries are getting consolidated in the financial statement basis, the unaudited numbers or the management certified numbers. So in all such cases, the possible effect of these undetected misstatements can be material, but not pervasive. If this is how the auditor concludes that the overall size of that item which he is perceiving, maybe there is a litigation ongoing in that entity, maybe there is a notice which has been received on account of certain tax non-compliances or other regulatory non-compliances, All those aspects the auditor will have to look into. If they conclude that those misstatements are material but they are not pervasive, then the auditor will again end up qualifying, because they are unable to obtain sufficient and appropriate audit evidence. But with the limited procedure performed, they are able to obtain that the overall impact on the financial statement is not pervasive, and hence they will be issuing a qualified audit opinion. But if the auditor concludes that the line item which is getting impacted on account of non-performance of these required procedures under the standards on auditing, and the auditor is unable to obtain sufficient and appropriate audit evidence, and the caption to which this this misstatement can impact is material, at the same time it is pervasive, then the auditor will consider to issue a disclaimer of opinion. These are some of the very generic or kind of a routine qualification matters, related matters that we come across, because these are the kind of non-compliances which might be which can be seen in various entities at the same time, because these are generic in nature or kind of routine in nature, like FEMA non-compliance, as I have covered. So FEMA, when a company is dealing with the foreign parties, there can be delays which can be remediated by the company also later on, by taking necessary approvals or waivers from the authorized dealers or the RBI, after making efforts to collect those dues or making those outstanding payments. So all those things can take place. The company can mitigate those by paying the amount of penalty and getting them remediated. So that can also be the case. In all such cases, you will end up issuing a qualified audit opinion, because the overall impact of that misstatement is material to the financial statement, but it is not pervasive. But at the same time, if that, as I've shared, if the overall ticket size of that aspect or the due which is there, supposedly it's a service entity, and the overall balance sheet size, if it will be looked at, the company is having around 60 to 70% outstanding as part of the trade receivables. So the overall financial statement caption to which this is going to affect is is resulting into a pervasive nature of an error or a misstatement. Then the auditor will not end up issuing a qualified opinion. They will be evaluating from an adverse opinion perspective. Second, which is very generic, which is seen in many of the cases, as there are new regulations, or there are new standards that we are coming across every year as we are evolving, and the overall financial reporting framework is evolving. So in such cases, there are high probability that the management or the finance team have missed out to consider the probable impact of the compliances of the certain new regulatory frameworks which have been introduced in the year, and accordingly those are having impact on your overall financial statement. So the auditor will be concluding that whether the non-compliance which has been committed on that account is pervasive or not. If it is not pervasive and it is just a kind of a material misstatement, then the auditor will end up issuing a qualified opinion. Otherwise, they will have to evaluate it from a adverse opinion perspective. So again, there's a very thin line difference there's a very thin line difference when an auditor will be concluding that whether the overall misstatement that has been identified will result into a qualified opinion or an adverse opinion. So there's always a kind of a dilemma situation. But this to analyze that which bucket it will fit into, the basic aspect that you need to look into is the pervasiveness of the error or a material misstatement that has been identified. If it is pervasive, you will have to move towards an adverse opinion situation, because the overall ticket size or the financial statements will get impacted with that entire material misstatement that has been identified, and it is pervasive. The other kind of the examples which ends up into issuing a kind of a qualified opinion is non-compliance of companies Act sections. There are various regulations sections which are applicable to the companies, especially in case of companies which are large group which are having multiple subsidiaries, and they are having transactions in terms of funding being given to and fro from the holding company to the other subsidiary companies, or they are having kind of a model wherein one service company is delivering services to the entire group, and they are having cross charge situations. All these things, all these categories are to be evaluated appropriately, and these can end up into a situation of a non-compliance of a particular section, like section 185, 186, 188 of the Companies Act. So while evaluating those sections, the auditor needs to evaluate whether the impact of those non-compliances is material. If it is material, then obviously the auditor will have to identify, auditor will have to conclude that whether it will lead to a qualification or an adverse opinion. And if it is material and pervasive, supposedly the company has is breaching in terms of the multiple layers of the organization have been created, and they are investing into multiple layers of the entity. So money is getting routed from one entity to another entity to another entity, and ultimately the trail is getting missed out. So auditor is coming across a situation where it is ultimately getting identified that the money has flown out of that entity, and there is no trail available after that. So in all such cases, it becomes pervasive to the holding company as well, because the ultimate funding has started from the holding company, and there is a specific reporting for that as well under the 143 reporting. But from that perspective, the auditor will have to evaluate it is material or pervasive, or it is only material misstatement. So if it is on, then the way it is going to get concluded, the auditor will have to accordingly issue an opinion from a qualified opinion perspective or an adverse opinion perspective. Next is on the impairment of assets, which is very common these days, because after so if the company is having multiple branches, or company is having if the company is into a hospitality sector, say let's take an example, if it's a QSR kind of an environment wherein the company is running multiple stores, and the company, while evaluating those store related performances, they come across that few stores are not performing up to the level, and over there the ultimately from a CGU perspective, if you evaluate that the cash generating unit, so which is the independent cash generating unit, so if that CGU is not performing, then it requires an auditor to ultimately identify and conclude that whether an impairment is required over there or not. If the management is not considering an impairment of those assets, and the auditor concludes that it results into material misstatements to the financial statement, then the auditor will end up qualifying that aspect in the auditor's opinion. If the auditor concludes that the overall impact of those assets which needs to be impaired, so supposedly there is a plant which is not performing, and the company has incurred a significant amount of investment on that plant, and which is covering a big ticket size out of the overall balance sheet size of the company, then it becomes pervasive. Then the overall impact of that impairment of asset will ultimately result into a kind of a material and pervasive error, and will result into an adverse opinion to be issued. So similar is the case of going concern. In case the company is having appropriate, the company is able to get support from the parent entity, and ultimately the auditor concludes that or basically the company justifies through its projections that the company will be in a position to sustain or be stable or run its operation for the next foreseeable future, and the auditor concludes that basis the limited documents available or the past trends, the auditor concludes that the company is will be having a challenge in terms of going meeting the going concern assumption. Then the auditor will consider to either qualify or issuing an adverse opinion on the going concern assumption. So that depends on the again the quantum of the misstatement or the overall ticket size of that. These are certain kind of cases which wherein the company auditor might issue a disclaimer of opinion, where, as I've covered this in the previous slide as well, the management does not allow the access of the financial statement, which is covering 90% of the group overall group net assets. So in such case, the auditor will not be in a position to perform appropriate audit procedures to conclude that there is no material misstatement which has been missed out by performing the necessary procedures, and hence the auditor will end up issuing a kind of a disclaimer of opinion, because there is a scope limitation, because the auditor was not allowed or supported in terms of seeking the necessary and corroborative evidences, audit evidences, to conclude on this matter. Similar is the adverse opinion. So as we have discussed in the past, so like a going concern situation, wherein the auditor has got a support letter from the parent entity while evaluating. So there are so let me cover this aspect because this is also important. There can be situations wherein the company is arranging support letters from the parent entity. The company is a subsidiary, and it's a kind of a subsidiary of a global entity, or a parent which is in India itself. The subsidiary is seeking kind of a support letter from the parent entity. While evaluating the financial support which the company has obtained, the auditor will is required to evaluate the financial stability of the entity also, which is issuing that financial support. That whether they will also be in a position to support the entity with its operations, and they have sufficient liquidity or the funds available, and they are not having any fund related crisis or any liquidity risk which the auditor can perceive, so as to conclude whether the overall the consideration on that support letter can be taken or not. If the auditor concludes that the overall impact of the overall stability or overall financial health of the holding company itself is not being supported well with the financial statement or their financial performance, then the auditor will have to evaluate it from an adverse opinion perspective as well. So in all such cases, even if the auditor is issuing a qualified opinion or they are issuing an adverse opinion, in all such cases, the auditor should ensure that there is appropriate disclosure being given in the financial statement. If the company is not giving a kind of an appropriate disclosure in the financial statement, again leads to a situation wherein the auditor will have to seek whether it impacts the overall financial statement, and then a qualified opinion is required to be issued over there. Apart from these modifications, we also end up issuing unmodified audit opinions as well, but with an emphasis of matter paragraph. The emphasis of matter paragraph is, auditor can consider to issue an emphasis of matter paragraph if the auditor would like to draw the attention of the users of the financial statements to a particular aspect, particular nature of transaction which has been undertaken, any outstanding litigation which is there, wherein the auditor has is aligned with the management on the overall impact that has been assessed, and concluded that this is not having any material misstatement, this will not result into any material misstatement, then the auditor will not end up issuing qualified opinion on those fronts. Maybe there is a kind of a ongoing litigation in the entity, and the auditor has obtained all the necessary legal confirmation, legal evaluations from the legal compliance perspective or legal evaluation perspective, and finally the auditor coincides with the management and is aligned with the thought that this is not having a impact, this perceives to be not having a significant or a material impact on the financial statement, and accordingly the auditor ends up issuing kind of an unmodified audit opinion with the emphasis of the matter paragraph highlighting that specific note which is given appropriately by the management in the financial statement. So an emphasis of the matter paragraph can only be given in cases where the management is giving appropriate disclosure in the financial statement, because for an emphasis of the matter paragraph, the auditor will be highlighting that or drawing attention to that matter which the management has highlighted as part of the financial statement, and the preparation of the financial statement is ultimately the responsibility of the management itself. So the auditor will draw attention of the users of the financial statement to that aspect, and to ensure that the facts basis which the auditor has concluded that the overall impact of that item is not going to be material, or it will not result into a material misstatement, should be coming up clearly in that disclosure being given in the financial statement. Like in case of a litigation, if the auditor has obtained a legal opinion, then they should quote that they should ask the management to specify that basis the legal opinion obtained or the legal advice obtained, the company is ultimately evaluating and assessing that this will not result into a material misstatement, and hence there is no impact on the overall financial statement. But since the amount the litigation overall is significant to the financial statement, and the readers of the financial statement or the users of the financial statement should be made aware of, the company is ultimately giving up appropriate disclosure in the financial statement, which is being referred by the auditors in the auditor's report also. Apart from the emphasis of the matter paragraph, there are other matter paragraphs also which the auditors consider to give in the audit report. So these are certain kind of situations wherein the auditor, ends up giving emphasis on a matter paragraph in the overall audit opinion. First is on the impact of COVID-19, as we have all seen, in the past last 2-3 years, when the companies were getting hit badly on account of the operation side, or from a delivery side, or from the revenue side, or basically from a production side as well, because the market was not available, or the products or the inputs were not available. So those were the probable impacts of the COVID-19. So the auditors, work with the management. The management were able to justify to the auditors that they will be in a position to arrange for all those inputs, and they will be in a position to meet the requirements as will come across. So in such cases, if the auditors were able to obtain appropriate audit evidences and conclude that the overall impact of COVID-19 is not seeming to have a material bearing on the financial statement, then the auditor would have considered to issue a kind of an emphasis matter paragraph highlighting that the steps which are being taken by the management to mitigate the risk of the overall impact of COVID-19. So this is one example which we have seen very closely in the recent past. There are other matters also on these similar lines, like pending litigation. If there is any scheme of merger or demerger being filed, so you are preparing your console financials wherein the impact of the merger or demerger has not been considered because the court is yet to approve the scheme. So from the entity perspective, the company will be giving appropriate disclosure in the financial statement, and the auditor will attract the attention of the users of the financial statement by giving an emphasis of matter paragraph in the auditor's opinion to bring the attention of the users of the financial statement to that aspect, so that the users are well aware that this aspect is underway and the company is thinking from that perspective. And this becomes important from a going concern assessment perspective as well for the subsidiaries or the entities which are getting merged. Again, non-compliance with regards to the Companies Act section. So the Companies Act section which are not having material impact on the financial statement, which are having which are not having penal consequences, which are the overall impact or the penalty which is being attracted on those non-compliances is non-material to the financial statement. In all such cases, the auditor might not give kind of a qualified opinion because there is no material misstatement which has been identified. Whereas since this is with regards to a non-compliance of a Companies Act section, the company might be giving appropriate disclosure in the financial statement, and the auditor will bring the attention of the users of the financial statement to that aspect. Like if the company was required to say, comply with the audit committee to be constituted, and they are in the process when still identifying the audit committee members, and the committee has not been formed in line with section 177. So the auditors might be evaluating that what is the overall impact, and if the company has already filed for that approval, or they are in the process of identifying, and the meeting is yet to be concluded while we are issuing the audit opinion. So in all such cases, the auditor will end up evaluating it from a perspective that whether it will result into material misstatement or not. If it is not impacting materially to the financial statement, then the auditor will conclude to give an emphasis on matter paragraph in the auditor's opinion. Similar is the case which is very which is very common in case of fire, or in case of any natural disaster which has caused, or any kind of an accident which has taken place at any of the premises of the company, which has resulted into a significant loss to the entity. But the company, on the other hand, it is insured, and they have filed for the appropriate reimbursements or the claims with regards to that. But since the overall impact of this this matter is as per the auditors is required to be highlighted to the users of the financial statement, so that they are aware that this kind of an incident which has happened in the entity, and the company is in the process of filing the insurance claims or such stuff, and the auditor might conclude that since the overall impact of this item is not material to the financial statement, and it is just kind of a aspect which is to be mitigated, so they might draw attention of the users of the financial statements to the emphasis of the matter paragraph, and might not end up issuing a qualified audit opinion, because this is not resulting into material misstatement of the financial statement. These are the kind of examples which, with regards to the other meta paragraph, which is being given in the audit opinion as well, wherein say the physical verification of inventory was not performed, or the comparatives are not audited, or this is your first year of being appointed as an auditor, as we are all seeing rotation very frequently these days. The last year accounts was signed by a different firm of chartered accountant, and this year you are going to sign the audit opinion. So you might end up highlighting this aspect as part of the other meta paragraph in your audit opinion, that the previous year numbers have been audited by another firm of chartered accountant. So these are the kind of matters which will result into an other matter paragraph situation. Sorry. So these are certain kind of FAQs which are generally asked by the management while looking into the financial statements, which is also significant or important from an auditor to evaluate also. So like and if an entity is not having any material uncertainty regarding the entity to continue as a going concern, so management generally asks that whether they are still being required to management responsibility paragraph should still be continued in the audit opinion. So since this is required, because the management responsibility paragraph provides kind of a summary of whatever responsibility the management has to deliver. So the auditor still is required to continue with those aspects, even if it is not having any material uncertainty on the going concern. But the going concern assumption has been evaluated and validated by the management, and hence the management responsibility paragraph should factor that in, which is part of our standard audit report also. Another situation is if an auditor disagrees or is uncomfortable with the recognition, measurement, disclosure, or presentation of a transaction in the financial statement, can he highlight it in an emphasis of meta paragraph? So if the auditor ultimately concludes that he is disagreeing to or he is not comfortable with the disclosure made or the accounting being considered for any kind of a transaction in the financial statement, then this will not be a matter of an emphasis of meta paragraph. This will lead to either qualification or an adverse opinion, because ultimately this is going to have a impact on the overall. This will have a material impact on the financial statement. So the auditor needs to be thoughtful while issuing the audit opinion on these aspects. When the auditor's report is modified, how does this impact the auditor's opinion on the IFC, which I initially covered while we were discussing on the 143 reporting also. So if supposedly the auditor concludes that you have come across a situation wherein the physical verification of inventory has not been done properly, and this is resulting into a material misstatement, and you are ending up qualifying the accounts from that perspective, then on the other side, the auditor is issuing a kind of clean opinion on the IFC, which is ICOFAR. So this is not in parity, because ultimately if you are not able to conclude on the physical verification of the inventory and this is resulting into a material misstatement, then then this is having an impact on your internal control, which is operating on that financial statement caption as well, because the impact could not be avoided through the controls which have been designed or being operated or operated effectively on the ground, and hence the auditor should consider to qualify the ICOFAR opinion also to that extent, so as to cover the risk which has got identified as part of the audit procedures being performed over the financial statements. So these are the certain kind of matters which the auditor should be cognizant of. These are certain basic miss or the errors which are generally seen, which are kind of, some are procedural, or some are with regards to the quality review of the financial statement or the audit opinion being issued, like in various when various kind of situations, basis of opinion has to be changed. If you are issuing a kind of a qualified opinion or a modified opinion, then the basis of opinion should be termed as basis of qualified opinion. Whereas people are there are examples wherein the reports have been modified, but this heading have not been changed appropriately to grab the attention of the users of the financial statement, and this becomes an error in terms of the deliverable to be issued. again, the client has been referred to as the company in the auditor's report, whereas it is not actually a company; it is a trust or the Section 8 company kind of a entity, or any other entity report which is not falling into the company's definition. So it needs to be properly handled with. So 197 managerial remuneration, if IFC reporting is not applicable yet, it is reported. So all those things the auditors need to be focus on and to be considered while issuing the audit opinion. So this is the overall theme on the opinion that the auditor needs to consider while working on the issuance of the audit opinion, and while deciding that what impacts the overall misstatement is having on the financial statement, whether again it is material or immaterial, it is having a kind of the disclosure has been appropriately given, not given in the financial statement, it is pervasive or not pervasive. For all those aspects to be evaluated appropriately. There are other aspects of the audit opinion also, which with regards to the audit trail, which is a new regulation. Then there is a audit backup requirement, the backup of the data. So which will be covered by my colleague CA Pushkarji. So I will now request CA Pushkarji to take it over and take us through the remaining part of the agenda for today.
Yes, thank you so much, Pankaj. I will just share my screen. Probably need to just stop sharing so I can share. Just let me know once my screen is visible.
Yes, Pushkarji, your screen is visible.
Yes, yes. So thanks, CA Pankaj, for the overview on the entire auditing or auditors reporting. As most of you would know, there is a new requirement from current year onwards, wherein the auditor also needs to comment on the audit trail maintained in the accounting software. So we will just deep dive into this requirement because this is the first year of this requirement. We will just deep dive and understand what exactly how this requirement came up and what as auditors we need to kind of focus on. So first requirement came via the the first requirement came via the Companies Accounts Amendment Rules 2021, which required any company, which required basically the management of the company to maintain for any accounting software which the company used for maintaining books of accounts. It required the company to have that accounting software to have a feature of recording audit trail for each and every transaction, creating an edit log of each change made in the books of accounts, along with the date when such change were made, and ensuring that the audit trail cannot be disabled. So this was the requirement which came in 2021. Initially, it was applicable from April 2021 onwards, but subsequently it got pushed, and now beginning financial year 1st April 2023, it is applicable for the management or for the companies. At the same time, there was an amendment via the company's Audit and Auditors Rules 2021, which required the auditors to comment in their audit report that wherever the company has used an accounting software for maintaining its books of accounts, whether that accounting software has a feature of recording audit trail facility. Second, whether the same has operated throughout the year for all transactions recorded in the software. Third, whether the audit trail has not been tampered with. So as an auditor, now I need to also comment whether the audit trail was tampered with during the year or whether it was not tampered. There were no issues at all. And fourth, whether the company has maintained such audit trail and preserved the records of such audit trail as per the statutory requirements. So these are the four new reporting aspects which are applicable for all audit reports from current year onwards. While management is responsible overall for maintaining the audit, having an accounting software for maintaining the audit trail feature, ensuring that the logs are there, and ensuring that the audit trail cannot be disabled. As auditors, we also need to comment on the same via the main audit report. So maybe we'll just deep dive into this in the subsequent slides. Yes, so Institute has also come out with a implementation guidance on this. Again, let me repeat the requirement. Wherever books of accounts are maintained using an accounting software, there an audit trail feature needs to be available. So the question here is, what constitutes the books of accounts? Again, the guidance is quite clear on this, that whenever the records are maintained for all sums of monies received and expended and matters in relation to which receipts and expenditure takes place, or uh, all sales and purchases, goods and services by the company, assets and liabilities of the company, and the cost record. So books of account includes all these four aspects: the monies received, paid, the purchases, sales made, the assets and the liabilities, and the cost record. So any accounting software through which any of these four items are being recorded or maintained, that will constitute books of accounts as per the guidance. Then coming to what is an accounting software. Accounting software is anyways a computer program or a system that enables recording, maintenance, and reporting of books and accounts, and relevant ecosystems applicable to the business requirements. The functionality of such accounting software differs from product to product. Every organization today employs multiple accounting software, its operations and other relevant data, including collection of data. So again, as auditors and as managements of the company, identifying what will constitute an accounting software which is used for maintaining books and accounts, that will be very critical. And third, of course, the audit trail. Basically, it needs to be a visible trail. There needs to be one-to-one tracing, and it needs to be maintained within the accounting software. So the question here is the three W's, that who, what, and when. So who has made the edits, when was those made, and what edits were there made. And again, this needs to be there in a chronological order. For example, if an accounting software has a provisioning of the last change made, so it tracks whatever was the last change made by the user, that will not suffice. It needs a clear trail from the first entry till the latest entry, what all changes were made in the entries. So that's the overall requirement, which is applicable for both the management or for the company. So they need to have this functionality in their accounting softwares, and the auditor needs to comment on those. So again, like I said, the rule 3.1 of the accounting rules, which is for the company or for the management, they need to ensure that the accounting software used for maintaining books of account has an audit trail feature, has a edit log of each and every transaction, including the date when the changes were made and who made the changes, and ensure that the audit trail cannot be disabled. So, like I said, it is first responsibility or the primary responsibility of ensuring that this is the rules are kind of complied with the management of the company. So they need to first identify, the records and transactions, or the what accounting software are critical for maintaining books and accounts. They need to identify what software, what IP environment, what cloud infrastructure is being developed. Management needs to ensure that audit trail feature is active and captures the three W's, like I mentioned: who, when, and what. Audit trail is, again, there is no it is protected from any modification. There is no unauthorized usage, and they need to ensure that nobody can make changes in the software or the audit trail without a log being created. And last requirement for the management is that they need to ensure that the trail is maintained as per the statutory record requirements or retention requirements, which is typically 8 years. From an applicability perspective, this is applicable for all companies, whether private or listed, small, medium, large. It's applicable for all companies. Second, it's applicable, the reporting is applicable both on standalone and as well as consolidated financial statements. So when you report on the consolidated financial statements, it will be typically based on the reports received from statutory auditors of the subsidiary associates or joint venture companies that are, that are incorporated in India and not outside India. Books of accounts, so if, books of accounts are maintained manually in its entirety, that will not be covered as part of this. Only books which are maintained in an accounting software will be covered as part of the audit trail requirement. And software, if any software is used to maintain books and account, it will be covered under the ambit of this. So this is the overall requirement from a company perspective. Coming to the requirement from a auditor perspective, like I mentioned earlier, there are 4 aspects which the auditor needs to comment on: whether the accounting software has an audit trail feature, whether the accounting software is operational throughout the year for all the transactions recorded, whether the audit trail was tampered with during the year, and whether the company has preserved the audit trail records, retained the records of the audit trails for the 8 years as required by the regulations. Now, there are few aspects, which are critical in this entire scenario. First is, identification of books and accounts. So what constitutes the books and accounts will be very important. For example, a company is maintaining their entire accounting in an application, but then there is a separate application in which the fixed asset register is maintained and the entire depreciation is calculated. The question will come up whether the separate application or the fixed asset register is part of the books and accounts, and whether such other applications should also be covered as part of the accounting software used for maintenance of books and accounts. So we discussed, there is a FAQ given by the institute on this where they have clarified this question, but these are the typical considerations which you need to be aware about when auditing this audit trail. Second important consideration is that what are management's control as an auditor. We need to evaluate what are management's policies and controls in relation to maintenance of audit trail, and we also need to perform a test of controls procedures around it to understand whether those controls are operating effectively. Typically, the company would have processes or controls around authorization of who can access the audit trail, who can access the application, who can access the specific database. So those controls related to those IT systems needs to be tested. Third, there is a question whether this reporting requirement is also applicable during interim or limited review. The answer is no. This will be only applicable for the year-end audits which we do. Fourth, if you some companies are also debating if they have some of the self applications wherein as per the functionality of the application, no edits can be made in an entry. So either you can altogether cancel the entry and pass a new one, or you can't just edit anything. So you can't change a number. So if an entry is passed incorrectly, then you need to kind of reverse the entire entry and pass a new one. But there is no functionality to just go and edit the entry, change the number. But again, if you see the requirement from an auditor's perspective, it says first requirement is that whether the accounting software has an audit trail feature. Now, in such cases where even editability is not allowed, but that does not mean that the application has an audit trail feature. And that again is an important consideration which the auditors needs to keep in mind while reporting on this clause. Like I mentioned earlier, again, who, when, and what. So who made the change, when was the change made, and what was changed. So all these 3 aspects needs to be captured as part of the audit trail. So for example, there are certain applications wherein the audit trail only captures who made the change and when was the change made, but does not capture what actually changed. So that again, from a requirement perspective, may not comply with the requirements because as part of the audit trail, you don't really know what was changed. You just know who has changed it and when it was changed. So again, it's very important that whatever applications the clients are using, whether they satisfy the requirements of all these 3, that is who changed it, when it was changed, and what was changed. A lot of clients or companies use third-party service providers. So there are applications which are outsourced to third-party service providers. They run the entire application, and the company does not really control the application as such. So there again, it's important generally such companies or such service providers are audited by another set of auditors who issue a SOC 2 report, which is the service organization control related report. So those reports, in those reports, those auditors also comment upon the audit trail feature. So as chartered accountants, we need to ensure we get those reports from the management and ensure that the other auditor has commented on or the service organization's auditor has commented on the audit trail feature, and they have, and we can as auditors rely on such reports. Another, important consideration is like, there are, in a lot of applications, there are super user access. So while normal users have access to the application and there is an audit trail feature available for such users, but there are certain rights in terms of super users, which means that they can override, and they get access to everything across the application. And in such cases, whenever the super user access is there, a lot of times we have seen that the audit trail is not available. So while the application has an audit trail feature, it captures who, what, and when relating to all the changes. But in case of specific users, maybe one or two, that's what we are seeing, there would be, audit trail feature may not be available. Again, that would also be an important reporting requirement which needs to be considered while reporting, that whether, if couple of users do not have that audit trail feature, what does it impact the entire opinion which we have given? Next is again the database. So, a lot of applications, just to give you an example, SAP has a SAP HANA. SAP is the application, SAP HANA is the database. So question also has arisen that, whether the requirement is only limited to the application or it should be also extended to the database where the entire information is stored. So again, there is a lot of discussion around this which is happening currently, but the overall view that is coming in is that, and even which is clarified by the institute, is that considering that the database, the entire, requirement of this regulation is to ensure that the audit trail feature is available and any changes are tracked. If anyone makes changes directly in database and that cannot be tracked, then again, it will not fulfill the requirements of the regulation. And hence, it's important that any changes to the database, if they are directly being done, then the auditor needs to ensure that the database also has an audit trail feature which is available. And I think last, considering if the company does not have an audit trail feature or it's not active, then then the auditor also needs to evaluate whether that impacts the internal controls of the company, whether the other IT controls around the applications are operating effectively, and if not, then again the auditor needs to evaluate whether it impacts the opinion which is being issued on the internal controls of the company. So these are the key elements which need to be taken into consideration while reporting on the audit trail feature. Here I just listed down some of the examples which are available and what will be considered as accounting software used for maintenance of books and accounts and what may not be considered. So any accounting package which the company uses like Tally, SAP, Oracle, etc., that always will form as accounting software for maintenance of books and accounts, and it should be included for audit trail testing. Then there are certain subsystems, for example, QSR or POS system, wherein the billing happens through a POS system and the consolidated entries passed at the end of the month in the accounting system. So whether such POS system or such billing systems should be forming part of the accounting software, which needs to be covered for books of accounts, maintenance of books of accounts. The answer here will be again yes, if the detailed entries are in the separate system and only a consolidated entry is recorded in the accounting system, then the requirement is basically to have an audit trail log even for the other system where the detailed entries are available. So in such cases, again, it will again depend on case to case. If there are cases where each and every entry is again replicated in the accounting system, then you already have those entries in the accounting system and then audit trail log may not be required. However, we have come across cases where generally, because of the quantum and the size of and the volume of the data, a consolidated entry is recorded, and hence auditor needs to ensure that such systems are also covered as part of audit trail. And third, I think there are certain core systems which are generally used as part of supporting systems for your main accounting system. Example, some system is recording the attendance for the entire employees, or so another system is used to only give rebates and discounts, or there is a database management, document management system. For example, you scan the documents and upload it in the separate database or separate system. So those systems generally will not be included because logic is that those systems do not contain the accounting entries which are required, and hence an audit trail will not be required for those entries. But again, auditors need to be very careful and ensure that each case is assessed on each individual basis, understanding what are the functionalities of the system, how they are used, what they are used for, and accordingly decide whether they should be covered for the auditor's testing. So we will just deep dive into some of the FAQs which are issued in relation to this by the institute. First, like I mentioned, applicability. This provision is applicable to all companies, irrespective of size and nature, small, medium, private, public companies, banking companies, NBFCs. So this is applicable to all companies. Second, no reporting requirement if while issuing a limited review report or an interim report. This is applicable only when you are issuing the year-end audit report. Now, example, if certain company does not have the audit trail feature from the 1st of April 23, and they have started or they have moved to a system which has that feature during the year, and there is no reporting requirement to comment whether such implementation was done during the year. The auditor's responsibility is to comment whether the audit trail feature was available throughout the year. So even if it was available only for a part of the year, that it will still result in a modification or a reporting requirement for the auditors. Again, even if the accounting software, like the example I gave is, a lot of companies have outsourced the application to third parties. So they use third party application software. Example, SAP Ariba. Now that Ariba, the software is actually located in the US. So question is whether any application which is located outside India would be covered as part of the audit trail feature. The answer would be yes, because if it is used for maintenance of books and accounts for a company which is incorporated in India, then all those applications should be covered irrespective of where they are situated. However, this requirement will not be applicable for companies which are incorporated outside India. So if any company has a foreign subsidiary, then this requirement will not be applicable to such companies. Yes. Coming to accounting software, identification of accounting software. So like I gave the example of property fixed asset register, right? The PPE register. So it may be classified as an accounting software if the same provides direct and auto feed to the accounting software. So example, if it is directly linked to the tally and entries are automatically posted from the PPE register to the accounting software, then that would also get part of, then the PPE register would also be considered as part of the accounting software. Similarly, if there are any end user computing tools, like even spreadsheets, right? And if those spreadsheets are auto recording entries in the accounting software, and there is a direct and auto feed available, then those spreadsheets will also be covered as part of audit trail. So it's a very specific scenario. While you cover these aspects, it's important to understand how the other applications work. What is the interaction between the main accounting application and the other application, whether it's direct, whether there is auto feeding, and if yes, then accordingly scoping needs to be done on whether they form part of books of accounts. Like if there is no direct feed, and if you are maintaining fixed asset register in an Excel, and at the end of the month basis the workings done in the Excel and depreciation amount is calculated and that's recorded, then that such Excel sheets will not be forming part of the audit trail feature. So it's very important to kind of understand this distinction and then evaluate it at your respective clients. Yeah. Moving on, the reliance on the IT experts. So generally what ICA also, the institute also says that you need to involve an IT specialist to kind of evaluate whether the audit trail feature has been active for the accounting software. While you may rely on a third party expert for this, but the ultimate responsibility will be on the auditor for reporting. Like I mentioned earlier, whenever the applications are hosted by third parties, then the auditor should obtain the SOC 1, SOC 2, or SAE 340 type 2 type reports, which are generally issued to such third parties by the auditors or their respective auditors. And those reports will contain, auditors' evaluation of the effectiveness of the audit trail feature, which can be relied upon while reporting for the company. Yeah, like I mentioned earlier, whether the journal entries can be edited, not edited, that's not the requirement. The requirement is whether audit trail feature is there. So a lot of, I have personally experienced this, that a lot of clients have come back to me and said that, but we use a software where edits are impossible. So there is no question of audit trail, or there is no question of, requiring to include a modification. But again, if you see the requirement is quite clear that whether entries can be modified or not, that's not what an auditor needs to comment. The auditor needs to comment whether the audit trail feature is there in the accounting software. And if yes, you report that. So there are many accounting softwares where you will find that, entries cannot be edited. But even if that is the case, still reporting will be required to be done under this regulation. Yeah, wherever if it's maintained by third party, you are unable to get a SOC 1 or SOC 2 type reports. There is no alternative evidence available to say that the audit trail feature was operating effectively. Then modification to the report will be required. Yeah. Moving on, I think there are scenarios if the audit trail feature is there, if the company's accounting software has an audit trail feature available, but due to certain glitches or technical issues during a part of the period, say for a few days or few weeks, the feature was not effective. Then the question arises: what does the auditor need to do? But again, if you see the reporting requirement, it is very clear. First, whether the accounting application of the software has an audit trail feature. Second, whether it operated effectively throughout the year. So even if it was not operating effectively due to technical glitches or any limitations, there will be a reporting implication. It will be considered as a non-compliance and will automatically result in a reporting in the auditor's report. Like I said earlier, again, if the trail feature has not been enabled since commencement of the financial year and was only enabled prior to the year end, so say mid of the year it was enabled, because the reporting requirement says that you need to comment whether it was operating effectively throughout the year, it will again be reported as an exception. Yeah, and yeah, so again, if the accounting software maintains only log of the last or latest change, then this will be considered again as a non-compliance. Like I said, it needs to have all changes in a chronological order from the very first edit till the last edit, capturing the 3 W's which I mentioned: who made the change, when the change was made, and what was the change. So these 3 features are available, and it is available for all the changes made throughout the year. Then only it will be effective. Otherwise, we will have again a reporting requirement. Yeah. So audit procedures per se, if you see the FAQs, it says that company auditor needs to first assess whether the general IT controls are, whether they are present, whether they are operating effectively or not, and then if they are not operating effectively, then whether such ineffective IT general controls also impact the maintenance and preservation of the audit trail records. So that's another important aspect which needs to be considered. Audit trail is again an independent reporting requirement. Even if you have a qualification in the main audit report, it does not impact the audit trail as such. You need to comment on the audit trail with respect to whether you have any adverse findings in the main report. If there are some applications where a log is generated by the application detailing all the changes made throughout the year. So it's not specific to one entry, but it's a log of all entries together. And if auditor is, if we are comfortable that those logs capture all the changes, and if we test them on a sample basis and we are comfortable that those capture the changes, then we can rely on such logs also. It's not necessary that each entry has to have that log, even if the log is available on a consolidated basis, but at an entry level, then that should be sufficient from a reporting perspective. Another question arises whether materialities need to be, whether you need to consider materiality while reporting under this clause. So, this reporting is a very factual reporting. There is no, while, concept of materiality will apply, but the requirement is that the audit trail should be available for each and every transaction. So, if, the transaction for which the audit trail is not available is immaterial, even then we'll need to go ahead and report this because the reporting requirement states that all transactions, irrespective of the amount involved, whether an audit trail is available for such. So, we spoke about the transactions, but another question also arises whether the master data source, say vendor master or the customer master, employee masters, any changes to that data should also form part of the audit trail. Now, again, the question lies whether such masters form part of books and accounts. And the answer here would be yes, because such master data is forming part of the books and accounts of the company. And if they form part of books and accounts of the company, and if an application is used to maintain that data, then audit trail needs to be available for such application. Again, like I mentioned earlier, if the application or the accounting software has the audit trail feature, but the underlying database where the information is stored or all the entries are stored, that does not have audit trail activated, then again that would also result in a modification because the whole requirement of the regulation is to ensure that any changes to the information are captured correctly. So while the application has the audit trail feature, if the underlying database does not have it, the current view is that that should also result in a reporting requirement. And lastly, there is a requirement which again we'll cover in subsequent slides on the, daily backup of information. The question arises whether audit trail should also be, whether audit trail should also have a daily backup. Again, the answer here is yes, because audit trails also form part of books and accounts of the company. And the daily backup requirement is that the company needs to do a daily backup of all its books and accounts on servers which are located in India. Hence, audit trail will also form part of that reporting requirement. Here we have just included a sample illustrative what is the qualification or the modification which you can do. So the first modification where we need to report on 11G. So here you can bring out that all transactions or the accounting software was operated throughout the year, except for certain cases where it did not. Like in this example, it has said that except that audit trail feature for XYZ software used by the company to maintain payroll record did not operate throughout the year. So again, this needs to be edited and updated as and when this is the facts of each and every case. Second, again, we comment on whether during our course of audit we came across any instances of audit trail feature being tampered with. And then there is the third requirement that the audit trail has been preserved by the company as per statutory requirements for record retention. Now, the view here is that since the audit trail requirement has started from the current year, this reporting requirement will only be applicable, the last one, whether it has been preserved by the company as per the statutory requirements for record retention. So this requirement will only be available from the next year onwards. So for current year FY24, this requirement will not be applicable going forward for FY24 onwards. The auditor will also need to check whether audit trail has been preserved for the previous year has been preserved by the company. So that will be again an additional reporting requirement. And if you have a modification in this para of the report, then going back to 143(3)(b) reporting, where the auditor has to comment whether proper books and accounts have been kept, which proper books and accounts as required by law has been kept by the company. Again, there also there will be a corresponding modification to say that yes, they have been maintained, except for the matters which are stated in paragraph or under reporting rule 11G. So again, a cross reference needs to be done in 143(3)(b), where we comment on the books of accounts as required by law, whether they are maintained by the company. A cross reference needs to be done to 11G. And again, there's another section 143(3)(h), where again we have to cross reference to bring out that the adverse remarks or the qualification in relations to maintenance of accounts and other matters are stated in paragraph dash and dash. So you are again will reference back to rule 11G para and 143 para. So this is quite critical because a lot of time what happens is that we ensure that we report the exception under rule 11G. However, a cross-referencing under 143(3)(b) and 143(3)(h) is not done. So this needs to be ensured while completing the reporting requirements. So this was all on the entire audit trail feature. There is a new reporting requirement which came, or not a reporting requirement as such, but there was a requirement for the company. There was MCA circular on August 2022, which required all companies to whoever maintains the books of accounts and other relevant books and papers in electronic forms. So there was a requirement on the company of three things. First, that all such books should be accessible in India at all times, so that they can be subsequently referenced. Second, such backups of such books of accounts and other relevant books needs to be kept in servers which are physically located in India on a daily basis. So this is an important requirement which was amended by the MCA circular dated August 5, 2022, which now requires all companies to ensure that they back up their books of accounts and other relevant books and papers if they are maintained in electronic mode on servers which are located in India on a daily basis. So earlier the requirement was periodic basis. There was no mention of servers, whether the servers are located in India or not. But this is impacting a lot of companies, because especially MNC companies, subsidiaries in India, foreign companies, generally what happens is they use a common accounting software, and as such backups, while the backups are done on a periodic basis, those are located in servers of the head office, which may be outside India. So that again, the requirement of the MCA circular states that it needs to be backed up on servers which are located in India, as well as it needs to be done on a daily basis. So this is again a very important requirement and important implications for a lot of companies. And the companies also need to disclose annually to the ROC the name and address of the person in control of books of accounts and other books of papers in India. So they need to do it. But from an audit perspective, this requirement becomes very critical because when we are reporting under rule 11G, there we need to again comment on, 143(3), we need to again comment on whether no proper books of accounts are maintained by the company. Now, and proper books of accounts as required by law are maintained by the company. Now, the law requires that the company should maintain books of accounts as well as do daily backup of such books of accounts on servers in India on a daily basis. So that again, if this requirement is not fulfilled, if the companies are not doing this, then again the reporting will be triggered. So, again, we discussed about, what is books of accounts. We spoke about that earlier. So if it is maintained in electronic form, so if it's maintained physically, it will not get covered. If it's maintained in an accounting software in an electronic form, then it will be covered. Second, I think the important, the aim of this entire amendment was to ensure that there is no manipulation of the books of accounts, both audit trail and backups. So a lot of, I think there were scenarios where a lot of companies said that their books have got corrupted, they are not able to access them. So to ensure that this does not happen during any proceedings, the new regulations have come up which require the company to do a daily backup on servers also which are located in India. And yeah, and the second reason I think is that whenever investigating agencies require this information, it is easily available. There are no cross-country rules which kind of prohibit the investigating agencies to get that information, and that is why the rule has come in that the companies need to maintain this on servers in India also. So, like I mentioned, 143(3)(b, where we comment on whether the company has maintained books of accounts or books of accounts as per the required law. If they are not doing the daily backups, then again a modification should be included. We need to include a language to bring out that the books of accounts are maintained. However, the daily backups as required by these regulations is not done by the company. Or there may be some scenarios wherein daily backups are done but not on servers in India. So again, based on case-to-case facts, we can bring that out in the reporting. Again, few key considerations here, like if there are hard copy backups, PDFs which are available, those need not be backed up. You need to ensure that the servers or the accounting information is backed up on servers in India. Again, if accounting information is stored in third-party service providers, like I mentioned for audit trail, there are various reports which are available, SOC 1, SOC 2 reports, which you need to ensure you get from the service provider, or the which the management needs to ensure they get from the service provider, and give those reports to the auditor, who can then see whether the factually the backups are being done on a daily basis on local level. And again, the requirement here is specific. So a lot of companies which we saw had maintained backups on hard drives or on tapes, but since the requirement is that that the backup should be done on the servers which are located in India, backups on CD drives or tapes or hard drives will not suffice, and again that will be a reporting requirement. So this is the important change. It was already applicable for last year, FY23, and will also be applicable for the current year. Yeah. So these, I think these were the two major modifications or the new amendments which were applicable for the current year. Happy to take any questions if anyone has.
Thank you, Pushpaji,
Thank you, Bhakarji,
for sharing your valuable experience with us and very useful session. We shall now take off the question answer session. First, I request to my moderators, CA Sumit Bansalji, to please take off the questions with CA Pankaj Handaji.
Sumiji, you are on mute. You are on mute.
Yeah, thank you, Pankaj. So I will read the question one by one. So there is one question there is one participant which asked whether these transactions will be reported in the matter of emphasis in audit report. Petition has been filed in NCLT Tribunal under Section 9 of IBC. NCLT appointed resolution professional to carry on the functions mentioned in IBC. Landed property are subject to revaluation, which as per basis of preparation, company is supposed to follow. I guess there is two questions. One says whether petition has been filed in NCLT and NCLT has appointed RP. So this needs to be reported in emphasis of matter or not.
Sorry. Yeah. So I think. So thank you for this question, Sumiji. So when you are evaluating, if the company has filed for a petition in the IBC under the IBC and the petition is being filed, obviously it needs to be identified from a perspective the company is not being handled as a going concern now. So from that perspective, anyways, going concern related qualification or an adverse opinion review will come. But from an IBC perspective, it will be a part of emphasis of matter paragraph that this proceeding is underway, and whatever the outcome of the proceedings will be, those will be accordingly implemented.
And sir, there is one more question in the same. Landed properties are subject to re-evaluation, which, as per basis of preparation, company is supposed to follow. Basically, participant needs to have that company's property are subject to re-evaluation. So, ये emphasis of matters में add करना है, and key audit matters where we need to mention that.
So these are two separate aspects. So when you are saying that the valuation is yet to be decided, so you need to see that the overall impact of that valuation pendency. Because if that pendency is there and it is going to have a significant impact on your overall financial statement, then it is not a matter of emphasis of matter. It is to be evaluated from a modification perspective also. Okay. And as part of CAM is a different guidance altogether. From a CAM perspective, since this is kind of a significant amount and material amount or a material item in the financial statement, the overall valuation of your financial assets or non-financial assets, this will be a part of the key audit matter also. So that is a separate guidance to be referred to.
And so there is one more question that one participant says there is one listed company who is not using edit logs or facilities. Then how we report it?
Sorry, can you repeat, sir?
There is one more. There is listed company who is not using edit log audit trail feature software. Then how we need to report the same in audit report?
So, Pushkarji, you will be taking this.
Yeah. So, like given given a suggestive language, so this will have clearly need to be brought out. There is a specific reporting requirement wherein we need to comment on whether the audit trail feature is available for such accounting software. So that there we need to bring out that the audit trail company does not use an accounting software which has an audit trail feature. That needs to be brought out, and then again under 143.3. When we talk about maintenance of books and accounts, there again we need to report or cross-reference this clause and say that except for maintenance of audit trail, the rest books of all accounts are maintained appropriately. And again, like I mentioned, overall you need to also evaluate whether this non-maintenance of audit trail, along with the IT general controls, if they are ineffective, does that impact the overall internal control environment and ICFR reporting for the auditor?
And so there is one more question that many participant is asking: in case of small companies that are having very few transactions, then how they need to implement these audit trail features, because they don't have that kind of infrastructure and that basically finance part also, posting part also.
So first question is, if it's a small company, are they maintaining the books and application, or are they maintaining it physically? So the requirement of audit trail feature is only when the information is stored in an accounting application or an accounting software. And I believe a lot of these accounting software providers have come up with newer versions where the audit trail feature is available, and which are especially targeted for such small companies at a very low cost. So there they have, came up with new versions where the audit trail facilities are available, and those account applications can be used by such companies.
Sir, there's one more case that in case of small company, what used to happen, they don't need to. They don't have permanent accountant. They usually outsource their accounting work to CA or any other part-time accountant, that they are doing work bookkeeping in their office, or that. Then how do they need to ensure that they are having the audit trail features? How auditor need to ensure that they are having the audit trail features?
So, the company will need to provide evidence that how the third party or how the external chartered accountant is maintaining the company's books. So if the external chartered accountant is, for example, using a tally feature or a tally system to record the company's, then whether that tally version has the audit trail feature and whether it has been maintained or operating effectively throughout the year. Now, it's very easy to say, but very difficult task to do. Or kind of for an auditor to kind of check whether the third party who's probably keeping books for many companies, whether they have that audit trail feature. But that is the requirement of the regulation. So So I think the easier way out here would be, if you are saying it's a very small company and the auditor is unable to get that sufficient evidence that the third party chartered accountant is using an accounting software which has an audit trail feature, then it would probably be best to include a modification in the report. It's not a modification to the main audit report, or the basis of opinion continues to be the same. It's just the additional reporting requirement under the legal and regulatory matters where the auditor needs to comment on whether the audit trail feature is available. And it's a factual reporting which the auditor needs to do.
Okay. Thank you, sir. So now I would request my co-moderator, C. Pankaj Jainji, to take up the questions.
पंकज जी आप म्यूट पे हैं.
Thank you, sir. Thank you, Sumit ji. Sir, please give some name of the entities which can refer for modified audit report issued in the public domain, listed companies.
Sir, you will have to search the domain. Can't. Indorama Synthetics you can look into. If I'm not mistaken, there was a modification there. Qualification. I'll have to search. So this will have to be searched.
We will forward this query to the member later.
I'll forward this.
Yes, sir, we will forward the later.
Yes, sir. One more question, sir. Whether any modification including EOM to the audit report shall be approved by the another partner of the firm and other than engagement partner and EQCR partner. Hello.
Sorry, I could not hear the question properly, sir.
Sir, whether any modification including EOM to the audit report shall be approved by the another partner of the firm other than engagement partner.
So this is in line with the audit quality, the ISQM compliance and the AQM compliances. So if you are having an EQCR on the role, and the firm has defined designed a methodology that it has to come through multiple channels. So like there are firms who look into the languages also being looked into by a special team who just look into these kind of consultations and ensure that there is a kind of a streamline or a kind of a aligned languages going in cases which are similar. Like for FEMA kind of qualifications, you will find from if say X entities auditing multiple clients. So you will see that largely the languages are aligned in all the entities because there is a standard or a central team over there.
One more question. In the clause H of the section 43(3), what does the reservation relating to maintenance of accounts and other matters therewith means?
What is it in 143(3)H?
Haji. What does the reservation relating to maintenance of accounts and other matters connecting therewith means?
It's under 143(3). It's not under 143(3)H.
Yeah, I think 143 talks about if there is any qualification or modification related to which impacts the books of accounts, then you need to specifically bring that out and do a cross-referencing to the respective clause. So that is only applicable when there is a modification. If it's a clean report, then I don't think 143(3)H reporting is required.
So that is 143(3)A, wherein any modification which is being done with regards to maintenance of a books of account, if you're qualifying or modifying your opinion in the main report, that is where I said in the initial session also that the auditor needs to get that fact into 143(3) reporting as well, because they have to be in parity. If you are saying that you have not been able to the books of accounts not being maintained properly in the main audit opinion, it cannot have a different call out in the 143 reporting. So it has to be aligned.
Okay. Sir, one more question. Auditor has issued the negative report in the earlier year for the non-capitalization of CWIP.
For the
capitalization was made Hanji?
For the non-capitalization of CWIP.
Hanji. Through the capitalization was made in the next financial year without proper documentary evidence as to the date of completion of the assets or non-realization of the capital and revenue items. Can he give the disclaimer of the opinion in the next financial year?
It has already been addressed why a disclaimer of opinion will come. If I have understood the question correctly, there was a qualification in the previous year that on account of non-capitalization of certain related item, capital work in progress item. So second part of the question relates to is that if they have now addressed that capitalization aspect and they have been capitalized.
Second question is that sir, next financial year documentation evidence complete कर लिया. But non-analyzation of capital revenue item उसको analyze नहीं कर पाया कि capital item है या revenue items है. And he's give the disclaimer opinion in the next financial year again.
That depends on the overall quantum. So in the last, if you are concluding that the company has capitalized an asset, so when you were recognizing the capital work in progress also, the same fundamental applies to that as well. You need to evaluate that whether that meets the definition of a capital asset or not. If that does not meet the definition of a capital asset in the previous year itself, it was supposed to be given an adverse opinion or disclaimer of opinion in the absence of the information. If you have got the sufficient appropriate audit evidence and you conclude that the overall misstatement is material and it is pervasive, then the auditor should have given a kind of an adverse opinion. If the auditor believes that they have not got these appropriate supporting evidences to conclude that this material misstatement is ultimately getting resolved and it becomes pervasive also, then it becomes a kind of a disclaimer of opinion.
Okay.
So this should have been a disclaimer of opinion or adverse opinion in the previous year also if the auditor concludes that it was material as well as it was pervasive.
Thank you both of the guest speakers for addressing all the questions of the session. I once again thanks for both the guest speakers for giving us delight. And now I request to Mr. Anil Lalji, please take over.
Thank you so much, sir. Thank you so much, Pushkar ji. Thank you so much, Pankaj ji, for such a wonderful deliberation. You have justified with your deliberation and covered all the aspects of press report, modified as well as non-modified, as well as the audit trail and backup audit backup also. So on behalf of AASB of ICI, I extend my heartiest thanks towards both the learner speaker, CA Pushkar ji and CA Pankaj Handa ji, for sparing their valuable time and acceding to our request during this audit season, as well as both of you are having the audit committee meetings, and still you have giving your kind consent for such deliberation for our members. So thank you so much, Pankaj ji, and thank you so much, Pushkar ji, for the wonderful deliberation. I also extend my heartiest thanks towards both the moderators, CA Pankaj Jain ji and CA Sumit Bansal ji, for sparing their valuable time and moderating this webinar in a very coordinating manner and very efficient manner, and acceding to our request to moderate this webinar. Thank you so much, Sumit ji, once again, and thank you so much, Pankaj ji, once again. I also thanks all the participants of today's webinar. So thank you so much, everyone, for joining. Thank you so much. Thank you.
Thank you.
Thank you, sir.
Thank you,
Okay.
sir. Thank you. Thank you.